Joining us now for reaction is Mark Mahaney from Evercore ISI. Mark, I mean, there's a lot in this report, it seems like, at least from first glance, to like. Why is the stock down 3%?
Because this was probably the single highest expectation stock in the internet sector going into the quarter. I think Meta's bar is going to be high too, but Netflix had the highest bar. They needed to do something like 4 to 5 million sub ads this quarter. They beat that, but I think the market was kind of even looking for 7 million next quarter. So it's really what I call an expectations correction. You step back and think about this fundamentally. You know, these initiatives, the two biggest ones out there, paid sharing and the basic with ads, they're starting to pay off, particularly the paid sharing. I think this basic with ads the ads program will also really pay off for them. It's going to take them a while, but fundamentally things are better. And the only other key thing to point out is the free cash flow outlook. They upped that from $3.5 billion to closer to $5 billion. And the bulls on the stock want to look at how much free cash flow they can generate. I think they're going to be positively surprised by this. So yes, you have an expectations correction, but I think all in, the fundamental story is getting stronger, not weaker.
Interesting. I mean, the fact that you saw net ads that were 3 times stronger than the street expected, it looks like they're forecasting for similar additions in the current quarter as well. And yet, at least in Canada and U.S., as Julia just pointed out, average revenue per user is almost essentially flat. I mean, what does that tell you about who's signing on to or who's not signing on to the ad-supported tier?
Well, the overall, I think the revenue per user, the monetization, probably came in a little lighter than most people expected. There are these ARPU drivers, average revenue per users, that are going to work very positively for the company as they get people to either go with the ad-supported plan where ARPU is higher than the basic plan, or they get them to shift up to the standard plan. So the ARPU engine is there. It's just going to take it a little while to get down the track. I hope I didn't ruin that analogy, but I think that's what's going to happen. In the meantime, you have a little bit of an air pocket on pricing because this is the company that consistently and probably too much raised fees over time. And so now they're comping against a period where they no longer have those price increases as a tailwind. But that ARPU tailwind is coming. It's just going to take a while for advertising to ramp up. So that's what the bulls should focus on.
Okay, well, Mark, this stock has got you in kind of a funky spot because you had a $400 price target on it, right? You removed it from your top picks list last month, but you still kind of like it, but the expectations are high and it's down after hours. So what do you do?
Yeah, so you spend some time listening to them on the call. This is what you want to hear them talk about. How fast do you think you're going to be able to ramp up this ad-supported offering? Password sharing, break it apart by country for us or by region. Tell us where you think you're having the most success, where you're getting the most pushback. What's your view, Netflix, on how many of those 100 million password borrowers, including my kids, are going to sign up for their own accounts or have their parents pay for it? I hope it's the kids paying. And then, so those are kind of the questions. And then talk about profitability. So they're showing you really nice margin leverage in the back half of this year, but yet they're kind of keeping the full year margin the same. I'm a little surprised by that. And then you started ramping up share buybacks. How consistently are you going to do that going forwards? If the answers to those are relatively positive, you can stay bullish on this name. That's what you want to dive into in this callback.
Mark, I thought inflation was getting kind of under control, and yet we've got these Netflix hikes, right? Microsoft is looking to charge $30 a month for AI in Office, and Disney is also looking to charge more for a subscription. Is the consumer at this point going to be able to handle all that, or might we see some of these names kind of get rejected?
Well, that question is way above my pay grade, but I will make this point. Netflix is in a really sweet spot in this. Every other streaming company is raising prices. I think it was Peacock yesterday, the news was they're raising prices. Netflix is giving you the biggest price cut in the industry. So you can come in at Netflix now for $6.99. I think that's where a lot of those password borrowers are going to come in on the plan. That's the price of a cup of latte, in some major cities. It's really cheap for the highest quality entertainment package out there on the internet today. That's Netflix at $6.99. So yes, you're right. There's inflation with one exception, and that's Netflix. And the beauty of the Netflix business right now is that they're able to lower those prices by 30%. $9.99 went to $6.99, yet they're able to generate more revenue per user. Like you never see that in business history. That's why it's interesting being long. You should stay long Netflix. But there are these questions they need to address on the earnings call this afternoon.